Can you all hear me? Fab. Right, the webinar today, I was going to do slides and what have you, and with the movement that we've had since Friday, I thought it'd be better if we looked at live markets so that we could see exactly what we were talking about and do it as it was live. So I'm leaving it open to you to what markets you want to look at. For me, I'm just going to talk about the stochastics, the moving averages, the Bollinger Bands, rate of change, anything that you want to talk about, please ask, because then it was easier, obviously, for me. Now, if we take the stochastics first, you can all see the euro-dollar chart that's over on the screen, I presume. Yes, can we all see that? 4 minutes of panic. Right, fantastic. First we're going to start with stochastics. Now, stochastics I always find are like a leading indicator. Sadly not, no. One was coming up in less than a minute. Right, now if we look at stochastics, you can see the screen out to the right, thank the good Lord. Now, I always find that these stochastics are more of a leading indicator, and they tend to turn before the market has actually turned as with like price-wise. So you're always looking for divergence. You're always looking for the edge as a trader, how to get into the market. And these, I find, give you a really good indicator if you use it in conjunction with your other factors that you have. For example, Fibonacci, good resistance, trend lines, whatever. You can preempt a move in the market by using these stochastics. Now, if I just take this along here, you can all see that line. Okay, when the stochastic changed to going bullish, you can see that the market was actually not looking that great, and we stuck with it even though it did come down. It only come down to neutral on this bar here, so there was no reason to actually cut out of any long positions. So we're looking to turn now. This is a 60-minute chart, which I find for trading much more interesting during the day than I would do a bar chart, a daily bar chart. Now, if you see this, that the market is looking to turn, you look back at the last high of the stochastic, you can see it was there, and the price was lower than what we are now. So we are looking at the market to turn because the price is going away from the stochastic. And if you look down the bottom, you can also see that the RSI is turning off that line, and more importantly, we know we've got resistance up at 131.50. So there are quite a few reasons why at the moment you'll be looking to sell into the Eurodollar market. Thanks, Mel. It is a 1033. That isn't the way that they're set up on most systems, but I use a 1033 because it smooths it out a little bit more. I also use a slow stochastic because if you see when I put on a fast stochastic, you can see where it's all over the place. So you don't really want to use them unless you are a very in and out sort of trader from the market. So that's the one you want to get away from. You want to be using the slow. Took this one longer. Well done to you, Ray. Yes. And they help you. I mean, because when the market is looking really bad or really good, you do get these turns that maybe people aren't aware of because they're looking at other indicators. You find that a lot of people look at moving averages, but if you see the moving averages here, what we've got, you can see that they're actually lagging the price, and the reason you don't want them lagging the price is because once it's gone above, now if you did it the way you should use moving averages, by the time that they have all crossed, you're a point out you know, in the different direction, in the right direction. So this is why we use the indicators to preempt a move. So Ray and all the rest of us are looking to sell. I'm already short, sadly, of euros, a little bit further down. But you're looking at the turn now from 131.50 to 131.75. So within that band, you're going on reversal watch. You're actually looking for a place, A, to cut your longs, 2, to resell the market, even though the market on the 60-minute chart is looking quite big. You have to look away from that and go, well, do you know what? Maybe it's not. Maybe you're looking for a little bit of a turn, and that's the way we use these. Does anybody else use stochastics? Okay, maybe then. Yes, Mel, we know you use them. Yes, I think the ones that say no, the 15.55 I find is a bit too short. That's like a very fast stochastic. No, it's a bit slower as well. You want to try the 10.33. Trust me, you can overlay. You could. Yes, it is. The Williams percentage range is very much like the fast stochastic. Wakey, you're naked. Right, okay. Thought doesn't cross my... Right, 5.33 fast. Too fast. Okay. Try the 10.33. Overlay it. See what one you find the best. I mean, let's look at what we can do. Okay. We'll go on this and we'll modify it. Modify stochastic. Let's go on the 5. What was the... 5.33. Okay. Okay. Hasn't really changed it much, has it? So let's go on another one. I think if you look at that stochastic, I think you'll find it's slower than the slow stochastic. Yes, Joe, sadly. Yeah. Sadly short already. But you know, it's not the end of the day yet. Oh, good Lord. I stick to the 10.33 on all of them, in actual fact. The reason I do it is I like consistency and continuity, even continuity. And I find that these actually give you the best trading opportunities. It's not, they don't get you in, obviously they get you in. What was the trigger? The trigger was that I thought that at 131.25 we were going to be running out of steam. I was quite happy to be short going into that, as had missed it twice already. Now, I always stick to my rule of twice holds, 3 times doesn't. And sadly, the 3rd time it went up there, it went straight through it. But in any case, I still have the 31.50 programmed into my head from last week, so I'm not unhappy to be short on here. You want me to show it without show on chart, please? What do you mean? Well, we'll go to the longer term chart. So you've got the 240 there, and you can see that the 240 stochastics are just turning up, which isn't pleasing me at the moment. You go onto the daily chart here, and you can see that they're coming down. You've got also the 200-day moving average that is around this glut of resistance, which is up here. So we're going to find it quite difficult to break through this, apart from people taking out the stops. And we've been here before. We know about the algos and we know about the stops and the high frequency traders that want to break this resistance, which I'm saying to you is why we use the 131.50 level to the 131.75 as to stay in with your shorts. Now, as you can see, the RSI has turned down off of the 75% level here. We didn't quite make it, and we've turned down. Although the price is going up, you can see now where we have divergence. My stop loss will be above 131.75. We're looking for divergence, and the RSI and the stochastics can be your first look at, your first indication that the market is going to turn, because divergence is where the price goes away from the indicators. Now, I'm not talking about moving averages here. I am talking about stochastics, RSI. Don't really use Bollinger Bands, because most of the Bollinger Bands, they're an average, so they follow the price. So in hindsight, when you look at them at the end of the day, you think, oh, fantastic, I should have sold there. But you shouldn't really, because when it was there, the Bollinger Band would have been far away. It's only, it fits it as it goes along through the time periods. So that's why we're short of the euro. And also, we was at the 38.2% Fibonacci level. That's another reason. Correct, Gabrielle. That's exactly right. You're looking for the divergence is when the indicators start to go away from the price. A strong uptrend, downtrend, whatever, your indicators will be far apart and they will be going in the direction of the market. It is when they start to come down and the price keeps going up, you have a problem. Yes, you can do it in a 5-minute chart. It doesn't matter. Whatever you wish to trade in, whatever time frame you choose, you will be able to use all the indicators, all the moving averages, and whatever I use, RSI, you can use it in those very short-term charts. They're quite good actually on the 5-minute chart. If you're an in-and-out trader, you can get some really good signals. And I know that some of the algo systems are applied with a stochastic and an RSI on a minute and a 5-minute chart. It's just, I don't trade like that. It's too short term for me. Would you dare cost a win percentage? I think, if I'm being honest, it's probably 75%, which I think is a good risk reward, if you like. It's not bad. But you've got to use these in conjunction with other things. For example, you've got to use, if you had no position at all now, and looking at the euro, what would you want to do? You wouldn't want to be long of it, would you? Because you've got to battle your way through the 200-day moving average. You've got to battle your way through the 55-day moving average. So you'd be covering any longs and going short here. Yes, that's good. That a lot of systems are based on divergence. That's what they base them on. So you're quite right. That's a good idea. If you're going to use a divergence-based system, you're going to make money out of it. Now, I was asked earlier on how many pairs I look at. It's actually mind-boggling. It's 22 currency pairs. Gold, oil. I don't personally look at oil, but I've just started. Gold, S&P, Dow, Nasdaq. You mean the gold against the cable as opposed to gold against the euro? Pan on fire. As I don't know your other name. Right. Well, I could. Gold's been an absolute little star. I can show you gold. I can show you gold that I've done the workings on. There you go. Okay, now we know that was just an absolute nightmare of of a day yesterday on, well, Friday really, gold started to come off. And once we broke through this weekly trend line, which was there, we happened to do that on Friday, we were going lower. And I think gold now is going to reach a base. We've done the 50% of the weekly chart virtually. So even if we go a little bit lower, I can't see it going below 1300, although it's come up a bit today. We made new lows of 1321. And I think if we can stay above the 1350 area, we can go back, and we can go back to the 200-week moving average, which is at 1433. Now, yesterday it didn't pause there at all. It just sliced straight through it. I thought it would do. We bought gold, but we used very, very tight stops, and we didn't actually get more of that much. How do you create your 200-day moving average? I just put it on. I go into moving average. It's there, and I go apply. Okay, there it is. I don't know what systems you use, Gabriel. I do really. I mean, I started off on the floor where it was, all it was orders being given. I don't think anybody on the floor when I started really traded, because it was all, we were on the phones and they were traded into the execution hits. So no, we didn't take positions, but it was very, very, a very short time after that I did. So the floor happened in 1981. By 1983, I was trading. So it was only a 2-year on the floor. Although I stayed on the floor till 1986, before I went back to the office, I had my own personal account. And when I went back to the bank, that's how I found out how traders actually thought. I mean, we were so limited into what we could use to trade back then. I mean, we didn't even have charting packages. You had to write your own charts out, you know, and you used to make your point and figure charts and make your bar charts. You didn't have these systems that we have today. I think CQG was around, but nobody ever used it. I used to use ADP Comtrend, which was a system very antiquated. In fact, I don't even know if it's around. We used to use that. And we could see the flows. And when you're writing your charts, instead of just looking at them, when you're actually writing them out and you're drawing the bar chart, or you're doing the point and figure, you get to know the market more and more, I think. And that's how I learned, you know. I learned on support and resistances. I learned on pivot points. I learned on Fibonacci's. I didn't learn on stochastics because we didn't have them. RSI, it's dodgy with the RSI, Drew. And the reason I say that is because if you think of it, it's a relative strength index. Now, I remember way back in 1986 when the dollar-yen was going to parity, and the RSI for the last 2 or 3 months was like 5, went to 3, went to 2, went to 1. Now that was the euro, the dollar-yen going from like 210 to 120. So I use them as with the RSI particularly. If the RSI is really, really low, that's because there's strength behind the trend. I know it's the wrong way that anybody's ever been taught, but that's the way I interpret it. If the RSI is really high and it's still going, the market's in a strong uptrend. If it's low and it's still showing lower, it's in a strong downtrend. You're looking for the turn, and this is where the stochastics come in. You're looking for the turn where maybe the trend is changing. Whether you're looking at a 5-minute chart or a weekly chart, it really doesn't matter. Okay, you're looking for this. That's beginning to turn up. So is that. Therefore, I'll take profit on my position, and or I'll instate a new position. And I always have support and resistance levels. They are your main priority. Support and resistance levels, trend lines, take precedence over any indicator that you will see. No problem. Now, as we've had such major moves over the last couple of days, as I said, instead of doing slides, I thought it would be better and more up to date if I did this live with you and went along showing you what I'm looking at when I'm trading. I thought that would be a bit more fun than putting a slide up and going, this is an RSI, this is a stochastic, this is what we do. So, any market that anybody wants to look at specifically now, that you know has been a big mover over the last 2-3 days, Aussie. But let's go to the Aussie. Right, we'll start off with the daily chart. Fantastic. Look at the Aussie. We'll do the yen. Oh God, look, I've got a load now. Let's do the Aussie. We'll go back to we've done the euro. That's what we've been chatting about. The euro, we've done that. We're short, looking to go 31.50, 31.75. If you go above 31.75, you're out of shorts. Right. I'll never define channel specific than the other. You mean when the stochastics are overbought, but you haven't reached the resistance, don't you, Gabrielle? Because you're in an uptrend, so you're looking for a place to go take your profit. Yeah, I mean, let's look at the Aussie, and you can see that. You can see it actually quite clearly. I'll go back to here, right? You can see on that bit there, that's when the Aussie crossed to go lower. Now, if you look up here, rid of that line. If you look up here and look at this, you can see where the price was diverging. So there's 3 reasons to be short the Aussie. 1, you've got a double top. I can show this if I squidge up the market a bit more. There you go. You've got a clear double top. 2, that it didn't quite reach it. And look at this. You've got the market not going higher, and you've got the stochastics turning lower. So when you get the price that's gone up to nearly 106, you're looking at the market now going, okay, look, we've got stochastics diverging, look at the RSI, it looked like it was diverging. So you want to be looking to go short. Now you already want to go short because you want to sell in front of this point here. You don't want to be long. You want to be long if it breaks 106.40, which it didn't do. It came hammering down. Now, even on the downward move, you can see, we've been through the Fibonacci's, you can see that we reached the 61.8% retracement. This is where you would be covering your short positions. Why? Because you're using other things as well. This is a daily chart, she says, pointing with her finger. This is a daily chart. You're going to get correction. You're going to get correction probably back up to here, where you've got the trend line, 200-day moving average, 38.2, and the stochastics are showing lower. Yes, you can stay with stochastics overbought for a long time. That's what I was saying. As long as they stay overbought and go with the trend and they're not close together, that's fine. It doesn't tell you anything apart from the fact it's going up. You're looking for when the stochastics and the RSI turn lower and the price keeps going up. That's my point. You're using these as lagging indicators, especially the stochastics, because of what I've just said. So even though they show overbought, you're not worried about that. Doesn't matter. It only starts to matter when they start to turn. So at this point here, I'm on reversal watch. Lots of reasons I've gone through with you. My first port of call would have been obviously the 38% Fibonacci and the 200-day moving average. That's what I would have expected the market to do. Once we broke through these two trend lines and that moving average there, your next level really is the 61.8. When you say it's not trading and it is going sideways, if you look at what it's done over the last 6 to 8 months, yes, we're range trading between 101 and 106. Okay, most of the people that trade wouldn't say that was sideways unless you're a really, really long-term trader and you trade that selling at 106, buying at 101 and a bit range. Normally, in our daily trading, we're looking for things a little bit shorter term. So you can look at the 4-hourly chart, for example, and you get a better idea there. Yes, it is ranging, but within these ranges, you can get some really good moves, and you can be on the back of it. You know, I can't say, well, look, I'm going to sell at 106. Sorry, my little things. I'm going to sell at 106 and buy it back at 102. That wouldn't make me a good trader, really. You've got to try and take the maximum you can out of a market, either on a daily basis or over a 1 or 2 day or 1 to 3 day period. And to be fair, you know, that's been quite a good market to trade. I quite like the Aussie. So, you know, that's just a personal choice. That for me is a good market to trade. From a trend, Boyke, do I consider trends? Well, of course I consider trends. We've been through trends as well. You have the three trends: your primary, secondary, short term. You know, you can put them together. Now, if you look at the stochastics now on the Aussie, you can see that it's turning to go higher on the 40-minute, 240-minute chart. So is it going to go higher from this point? I'm short of the Aussie. I would hope not. I would hope that the market will come down here first, or around here first. Let me buy my shorts back. And then what I would do, I would now look at these two. I'd look at the 240-minute, the daily, and pick levels of where to go back in and trade. I know that between 103.85 and 104.100 is good resistance level. I don't need any indicators to tell me that. I know that because it's a market I write about every day, and I trade when it's doable to trade it. Not every day, but when I see a good level, I go in and do it, and this is how I do it. So I look primarily at the price trend line and what the stochastics and the RSI are up to see if I can, take a look at the monthly. Okay, on the Aussie. Yeah, it's not really telling me a lot, I've got to be honest. Apart from the fact you've got this triangle thingy here. Where's the trend? I've got too many. There you go. Flat. You'd be doing exactly what I've just said, selling up to 106 and buying it back around the 104, 103.80, selling below 103.75 for it to go to 103, 102.75. I trade on any time frame. I look at the markets from an hour onwards. I wouldn't necessarily trade looking at a monthly chart, and the reason I wouldn't, don't get me wrong, I know where the trend lines are on a monthly chart, obviously, but I would only trade off of a monthly chart if it was a massive big level there that I can see that I don't already have in my head. Now, if you look at the Aussie on the 60-minute chart, you can see that we are beginning to turn lower. I'll get rid of that one, on that one. We've already dipped down on the RSI and we're at neutral level, so even when it went up, it didn't really go up with any conviction, and as we've discussed in prior webinars, a market that's going to go down should only correct back to the 38.2 fib level if it's going to continue within its downtrend. Now, if you look at the hourly chart, you can see that the last 2-3 days, the Aussie's been in a downtrend. So, knowing that, that's how we can go in. If you can combine all of the data that's available to you, and it all screams at a level, that's the level you need to go in and either sell or buy. That's your first thing. If your technical indicators confirm, great, you have to trade off of that particular thing that you're doing. I like a 1 to 3 ratio, personally. I was always taught to do a 1 to 3 ratio. I think sometimes in difficult markets, if you take a profit, hey, you're not having a loss. I don't like to let winning trades go into a losing trade. I always prefer to move my stop down to the entry point, even if I get out at the entry point. But to watch it go 40-50 ticks lower and still have your stop loss 30 points or 20 points above your entry point, I don't think that's good trading. I like to use trailing stops. I like to lock in profit. That's just me. That's how I was taught. I do know that the people these days aren't. Do you know your winning ratio? Yes, I do. That's for another webinar. In my life story. Honestly, this is water. So now what do? We're looking at the RSI turning lower, we're looking at the stochastics turning lower, we're looking at the market backed away from its 38.2%, we're looking at the moving average down at 103.46. We know we have a little bit of support there from the 23.6 Fibonacci level, which is at 103.45. We know where we went in short. What should we do? We're going to draw a trend line on it as well. Now you can do all this if you've got the correct system. You can do all that. So we're gonna go that way. Sometimes it doesn't do it correctly. Gonna go up to there. Right. So we have already broken through the trend line. We've got another trend line. We can put on another one here. Okay. Which actually comes in, funny enough, at where the 23.6 and the 21 period moving average comes in with the trend line. We're all sitting there at 103.46. So what are we going to do? We're going to cover our shorts, aren't we, Mel? Buy them back and resell. We resell below 103.40. Okay. Because once that 103.40 goes, with our turning bearish stochastics and our bearish turning RSI, we should, in actual fact, come back to this area here, which is 102.90. So we would then be covering at 103. Which EMA lines do you have up and how do you use them? I don't have exponential moving averages. I have the 9, 21 and 55 simple moving averages. I I do look at EMAs at times. If I'm finding a particular market a little bit hard, I do an overlay, but normally I don't use the EMA, no. What a question, I don't know. Go down the pub. Am I really that boring? Seriously? Well, you're asking, thank you very much. You're asking the questions, I'm just providing the answers that you want. Is there any other market that you'd like to have a look at? Interested? Good. Okay. I wasn't feeling interested when I sold the euro, the Aussie this morning, bless it. We're all right. Right. Way back there we had dollar CAD. The dollar CAD is actually looking quite interesting. I'll just bring this up here. Right, first of all, we'll put on our moving average cross, we'll put on Stochastics, we'll put on RSI, which isn't up there. Okay. That's on the... Boy. Right, well, first of all, I would like to see what the daily chart... This is 60 minutes, so first of all, look at the daily. Okay, yeah, I mean, it does look like a buy. And one of the reasons it's looking like a buy is this. You've got that big, long pole. You've got that downward sloping flag. And what we should do now is once we've broken out of this, which we have, we want to measure there to there, and then we add the measurement there to, if you're conservative, the bottom here, and measure it up, or if you really want to be on the off the wall, you measure it from here up. So whatever you're measuring, it does look like the dollar CAD is going up on a daily chart. Probably then from 102.27 to at least 103.5. So 103.5 to 103.60, and probably 104.5. See, I've been telling you all things and you're all asking me questions, so I'm not looking. So let me go back. Daily, yeah, buy dollar CAD. Can you tell us about Technical Trades Institute? The STA, Society of Technical Analysis. Yes? Right, pan on fire. Correlation. You've got commodity currencies, which are the Aussie and the Canadian. The Canadian. You've got the Aussie and you've got the Canada, alright, which are known to be commodity-based currencies. And normally, they go hand in hand with the commodity which we're looking at, which will be oil, gold, whatever commodity you're looking at. Now, we do see decorrelation all the time, which is why I bang on to everybody. Just because gold is doing this, it doesn't mean that the euro or the Aussie will do that. You've got to look at every market separately and then take an overall view with your eye looking on the gold and the oil and the S&P, and you focus in. If you're doing the Aussie, you've got to be aware of what the Canada's doing, what the Kiwi's doing. Obviously, I mean, I do it, it's second nature to me now because I've done it for years and years and years. But new traders coming through, I don't think look at the whole global picture, if you like, and they should really look at a lot of things rather than focusing just on the euro dollar and the sterling when to go long on gold. You go long on gold, 13.5 to 1300. Okay? Gold does this a lot. If you look at gold on a monthly basis, although it has really gone down quite a bit this time, but if you go back historically, gold has been doing good corrections now since 2009. So The Society of Technical Analysts. What can I say? I suggest that everybody finds out from their own experience what they think of it. I belonged to it many years ago when it was run by Anorak, not run by, when most people were Anoraks, and I went to my first STA meeting, I think it was about 1986, 85. I personally wasn't too impressed with it, although now I think they've got a bit more up to date, and a lot of the people that are on the board are colleagues that I've worked with, trained over the years, so I'm quite upbeat about it. I don't belong to it personally myself because I don't think it has anything to offer me. I think when they look at a 200-day moving average, you've got to make up your own minds. Look, just have a little join and see what you think. You have to take an exam to join, I think now, whereas when I joined, they were dragging you in like when they used to, remember years and years ago when they used to sort of bash people over the head and they'd wake up and they was in the ship going to a war in King Henry VIII's time. And that's what they were doing at the STA when I first joined. It was like, please join, make up the numbers. Not such a great experience, but they do have quite good parties there. It's all free drink and free food, and that's it. Where would I have bought the Canada in my early days, boys and girls? Sadly so. There was two. Look, you've got the stochastics turning bullish. You've got this flag formation. If I do another trend line here, you've got this flag formation here, you know, and if you look and you've joined that one to that one, you could do another one really. It would give you the same signal. Once it had bounced off of there again and these started to move up, it would have been your first signal that you were going to go up to this point here. You would have covered longs here. You would have rebought on the bounce or back to the trend line. You see where it's just dipped below, but we've got all this support along here. And there's no reason I can see why you should not still be long of Canada. Okay? I thought about that yesterday as well, but I use the SMA really as support and resistances. I think if you're waiting for the market to cross, what I've personally found is that if you use them as support and resistance levels, you're probably going to get more out of a trade than if you sit back and wait for them to cross. Look, they crossed here. Okay? So although they crossed, you knew you were selling in front of this bit up here, so you were preempting it going lower. Also, you look at your stochastics that were turning lower, so you're going to get more out of a trade if you, as I say, if you use these as support and resistance levels. And if you can see, because they're lagging indicators, so I use 9, 21 and 55. As the shorter time period that you use, the quicker the signal will be if that's what you want to base your trading on. Personally, I don't like to do that because years ago when we used black box systems, and that was the only sort of black box system we had to use. So if the price closed below that moving average, you went into the trade. Now, that would have whipped you about, as it whipped me about. As luck would have it, we had our own trading desk as well as the black box system. So we used to get out. But you've got to really, the way it works is that on a close basis, well, that's great. But say here, you would have it closed below that moving average. Great. So you're short on the close. Then it goes straight back in your face and you're 2 points out of call. It's not a good idea. But if you use them as support and resistance levels, that's good. That is good. People always look at the 100, 200-day moving average, especially these days where the ranges have grown over the last 5 years, as opposed to in the early 80s when you had tiny, tiny little ranges. Unless the Bundesbank come out with something dire, or the BOJ, Bank of England, really didn't make a lot of difference. It was the Fed, the Bundesbank and the Bank of Japan really that moved the market. You see, as we speak, the Canada's gone up. Right. There is a defined risk here. You are buying Canada unless it goes below that trend line, and that trend line is at 102.09. So, if it goes below and stays below 102, 101.90, you don't want to be long. Right, Drew, I've told you about the SMA lines now. Ray, yes, gold is good for a correction. Well, it did that. I'm short of euros, so I yes. So we know support's at 40. Put the order in. I'm sure we've got the order in at 130.45. Sorry. I think we've got the order in at 130.45 on the euro. Okay. Now somebody asked me for the yen. Does people still want to see the dollar yen? It's a scary one. Okay. So we're going to move you back over there. Actually. And go to the Aussie. Yes! Right. So we're going to look at the dollar yen now. For instance, short of that as well. Better therefore, I'd say. Yes. Sorry. Okay, so we've got the daily. You can see with us. Yes, I am brave. Yes, I am. I was told that by my online live trading group this morning when I said, going to sell dollar yen. They went, good luck. I don't think anybody's actually followed me. Don't think so. But hey, look, pan on fire. Trading's a scary business, okay? You can't, if you're going to be scared to do anything, no, I don't like scan candlesticks, but I'll put them on. It looks different to me. They come from 3 years working at Nomura Bank and being told about candlesticks and digi-dojis and da-da-da-da-da-da. And I don't use them. I just don't like it. Right. See, their arm thrown now, I can't even see what I was looking at. Pan on fire. Listen to me. You can't be scared to do anything with trading, okay? You've got to grab that ball by the horns and get in there, because you've got to be in it to win it. That's the thing. And yin can be a really, really good. I have somebody else that screams at me, my little partner. It doesn't really. Candlesticks don't. They're just pretty. That's because I trade on bar charts. The only reason I put candlesticks on my reports in the morning is because at a glance, you can see the up days, the down days. That's it. But I use the bar chart because I like it. I don't need to see up days and down days. I just look at that chart and I find that the patterns emerge better. And I don't need to see emotion. Look, I can see it's gone up. I don't need green candles to tell me it's gone up. I don't need candlesticks to point out that little bit to me. You know, I just don't need them. In fact, I think they can actually make your trading not as good. That's how I found it, because so many people go, oh my God, look, it's up, it should be going up even further. No, not really. You know, look, it's gone up. You see this little flag here? Can you see it? Can you all see it? Ahmed was asked me to put up candlesticks. Right, you've got that little pattern there. And what did we say about patterns last time? A pole, an upward waving flag, which is what? Yes, bearish. So we're looking for the market to reverse up here in conjunction with our stochastics, and down we came. You're not going to get that out of a candlestick chart. You've got to look for that yourself. I'm really tired of these new traders coming through that have only been looking at candlesticks. They're really, what's the word I'm looking for? They can give you false signals. That's all I'm going to say. False signals. What are my stochastic values? 10, 3, 3. FX, I've got to go now, guys. Alright? Hope you enjoyed the live trading session with... No, I liked the upward waving flags and bearish flags. Okay? I prefer this way when you're doing it live. Thanks, FX Street. See you later. Bye.